Hello, my awesome accounting students. Welcome back to the last chapter. In this chapter, we have one that is jam-packed with information. We're in the final steps of the accounting cycle, and we have a lot to cover. This chapter will focus on the financial statements that a merchandiser uses. We will also cover the 4 closing entries that are a little bit different since we last discussed the closing process. And we'll take a look at some ratios that others, including investors, may use to interpret the financial data. In the first 6 chapters, when we were learning about service-oriented firms, we learned a basic single-step income statement. Basically, the formula was just the revenues minus the expenses equaled the net income or possibly a net loss. For merchandisers, we use a much larger income statement format called a multi-step or classified income statement. Let's look at it piece by piece. You will quickly see where it gets its name from. A multi-step or a classified income statement has all of the items or components divided into groups of similar accounts. You will also notice that there are various subtotals within the groups. You haven't seen this before because, again, we've used a single-step income statement. The classification and order of information depends on the type of the business and the expected use of the statement. The only way we're going to be able to remember all the different parts is to go back and recapture the information that we learned in previous chapters. You will remember that I encouraged you to learn it in chunks. That's my word. And today we're going to learn to put all the different chunks together. The first part of the multi-step income statement is the operating revenue section, or as we learned, the computation of the net sales. We learned this back in the chapter on sales. The next major chunk is called cost of goods sold. You have heard me mention this before. In a nutshell, as you'll see later, it's the net delivered cost of purchases tweaked for inventory. We learned about this back in the chapter on purchases. The difference between net sales and cost of goods sold is gross profit. From there, we deduct out the operating expenses, which will give us another subtotal called income from operations. We're almost done after that computation. We need to adjust the income statement for the other amounts, which GAAP defines for us, to finally get down to the bottom line or the net income. Again, we're going to focus on this in chunks. The first chunk of the income statement contains the revenue from operations. This is the revenue earned from the normal business activities. Other income from other sources would be presented near the bottom in the other section. Think of net sales. Net means after deductions. So in this section, start with the sales number and take out the 2 contra accounts. Deduct sales returns and allowances and sales discounts if offered, and you have the first chunk called net sales. The second chunk, and probably the most difficult one, is called cost of goods sold. You will see me often abbreviate it as COGS or COGS. The cost of goods sold section contains information about the cost of the merchandise that was actually sold during the period. There are 3 major elements needed to compute the cost of goods sold. The main one in the middle is one that we have already learned. In a nutshell, as you look at this slide, you'll recognize the net delivered cost of purchases. After we tweak that for inventory, by adding in the beginning inventory and taking out the ending inventory, we will have cost of goods sold. My guess is this chunk will take up the most of your memory bank, so let's go back and review this section. You will have to go back in your memory bank to the chapter on purchases. Again, focus on the chunk that we are computing here. It's called the net delivered cost of purchases. If you look at that and take it grammatically apart piece by piece, that means this is the cost of everything we delivered, including freight, net or after the contra accounts. Take a look at the slide and refresh your memory. Again, this is the biggest chunk contained within the cost of goods sold section. In the last slide, you saw the cost of the goods purchased. Remember what we're computing, it's the cost of the goods sold. So on this slide, you'll see the net delivered cost of purchases, what we just computed previously, adjusted for inventory. The beginning inventory is added, and the ending inventory, because it hasn't yet been sold, is deducted, and the ending result of cost of goods sold is computed. Again, this is the hardest chunk on the multi-step income statement. You're going to need to practice in order to be able to master it. On the next slide is a summarized cost of goods sold computation for the company described in your book. Let's keep making our way through the multi-step income statement. The gross profit is the difference between the net sales and the cost of goods sold. In other words, it's what the company generated in terms of profit just on the sale of the goods itself. This is before any of the operating businesses or costs of running the business are considered. So again, gross profit is the next subtotal that you will see, and it measures the difference between the net sales and the cost of goods sold. Here is the slide for the company that's demonstrated in your book. Notice that the net sales was $549,150. The cost of goods sold, or the costs of all of those goods that were sold, was $330,120. The difference between these two chunks is gross profit on the sales. This gross profit measures profit just on the sale itself. The operating expenses have not yet been considered. Working our way down the income statement, we have net sales less cost of goods sold gives us gross profit. What comes next are all the costs of running the business. These are often referred to as operating expenses. These are all the different types of expenses that we've been covering over the course of the semester. On the screen, you will notice the operating expenses are separated between the selling expenses and the general administrative expenses. The selling expenses are those expenses that are directly traceable to the sales department. Things like advertising and salesperson salaries. A key word in the selling expense line item is often the word store. You don't see it too much in this slide, but in practice, if you see the word store, chances are it relates to the selling expense. Everything else by default falls under the general and administrative expenses, sometimes referred to as G&A. The sum of the operating expenses are totaled in the... Sorry, that audio clip got cut off. The operating expenses are deducted from the gross profit to give the income from operations. In this slide, you'll see the last section of our multiple step income statement. we term it the other section. The other section shows income that is earned from sources other than normal business activities. Also, interest income or interest expense is always included in this other section. In addition, expenses that are not directly connected with the business also appear in the other expenses. Here is a clip from the company in your book. You'll notice that the other income included interest and other miscellaneous income and totaled $532. The other expenses also included interest expense in the amount of $770. These two are netted together and totaled $238. Since the other expenses of $770 were higher than the other income of $532, these are subtracted or netted to equate to a net non-operating expense of $238. Since this is a net expense, it will be deducted from the subtotal above it to come up with net income. Here's how that last section would look in the last half of the income statement. This net income represents the net profit for the year, and just as we learned before, will be carried over to the statement of owner's equity. Unlike the multi-step income statement that was vastly different from what we learned about in a service-oriented enterprise, the statement of owner's equity is identical to what we learned about in the first half of the semester. As you already know, the statement of owner's equity reports the changes that occurred in the owner's financial interest during the period. In this case, you can see that the owner, Bill Whiteside, increased his capital balance from approximately $61,000 at the start of the period to over $84,000 by the end of the period. This is still called the bridge statement, as that ending capital balance will transfer over to the balance sheet. The third and last statement is the balance sheet. Just as we learned in the first half of the semester, the purpose of the balance sheet is to show that the fundamental accounting equation is in balance. In other words, the balance sheet shows that assets equals liabilities plus equity. This balance sheet is a bit bigger because we've learned so many new accounts. In fact, this is called a classified balance sheet. What that means is the assets are classified into current assets and plant assets, and the liabilities are classified into current liabilities and long-term liabilities. It's interesting to note that equity is never classified. In this slide, you see the top half of the balance sheet, or the current assets. By definition, current assets are those assets that are realized or turned over within 1 year's time. A couple new things to note on this balance sheet is that accounts receivable must show the net realizable value either in the face of the balance sheet, as in this example, or in the notes to the financial statements. Plant assets, or plant and equipment in this example, are those long-lived or long-lived assets that last more than 1 year. Make sure you show all 3 GAAP components for the plant assets, including the cost, the accumulated depreciation, and the resulting book value. On this slide, you'll see all the different current liabilities that we have learned about over the course of the semester. Current liabilities, by definition, are those liabilities which will be paid off within 1 year's time. Although this company doesn't have any long-term liabilities, common examples would be mortgages payable or auto loans payable. The equity section, although not shown on the slide, is exactly the same as we learned previously. There is one line that says capital, and the ending capital from the statement of owner's equity would be carried over.